So the UK votes to leave the European Union. Markets across the globe fall. It's been described as a seismic moment for the UK. But what about for your investments? Well, Wei Li from iShares BlackRock is with us. Thanks for joining us. How would you describe the past sort of 24 hours?
It is definitely historic, and a lot of market participants didn't see it coming, as evidenced in the initial significant sell-off in global risk across the board. And it is likely going to have very long-term structural implications on the growth outlook of the UK as well.
Let's look at those long-term implications, but because it's not just the UK, but the knock-on effect on other economies and central banks.
Absolutely. So if you think about how future growth is likely going to shape up, a lot of it has to do with how the UK is going to unpack the UK law and EU law, as well as how the UK is going to go about negotiating new trade deals with the EU as well as with the rest of the world. And if you think about the contagion of what's happening in the UK to outside of the UK, a lot of European leaders are likely going to try to focus on domestic populist movement as well, and as a result of that, you could see them moving towards a harsher stance in the negotiation too. And not to forget that Scottish referendum could be back on the table. So all of this would have significant ramifications in how the future growth outlook could look like.
Because there are so many question marks and so many areas it impacts, from Scotland to Germany to the EU to the US trade to a certain extent.
Yes.
That's why we've seen so much fluctuations of volatility in the markets.
Absolutely. There has been a significant spike up in volatility indicators almost across the board. And central banks are definitely very keen to try to come in and calm down markets and try to provide ample liquidity to make sure that there wouldn't be significant funding stresses. I mean, we already heard from BOE, and they are not alone. We have seen ECB and BOJ joining the BOE in trying to reassure markets that they would provide potential support. And it is not entirely out of question that BOE could actually start cutting rates to closer to zero. They could even go back to quantitative easing.
I mean, okay, I mean, to see that then, I mean, that's got huge ramifications, hasn't it?
Yes, absolutely. Especially if you think about prior to the Brexit referendum, we were looking at the state of the UK economy and how they could actually potentially follow the path of the Fed policy normalizing, and now we're seeing a reversal of that. It would have definitely significant ramification on asset allocation going forward.
Well, let's look at that asset allocation, in particular ETFs, and how they've been behaving in this environment, and how they as an investment can be a good investment vehicle going forward.
Well, ETFs are made for these volatile times. So what we have seen so far today, after the announcement that came out this morning, is that many ETFs are trading at multiples of their average daily volume in the secondary market. And if you think about popular exposures that investors are focusing on, such as UK equity, such as gold, their liquidity, their volume so far today has actually been more than 10 times their average daily trading volume. So we definitely see investors using ETFs to play the market. And of course, ETFs are not going to be immune from the volatility that is happening in the broader market, but we have definitely seen ETFs bring in that incremental secondary market liquidity to the play, as well as providing this price discovery additional benefits when risks are actually exchanging hands.
You mentioned gold there, of course. We saw money going to the gold this morning. What other kind of assets within sort of ETFs should people be looking at?
Well, we have seen a significant amount of inflows going into gold, not only recently, but also year to date. If you think about the broader environment of rising volatility, gold has been a major beneficiary of that. Investors consider allocating part of their portfolio to gold as one way of getting some sort of safe haven assets in their portfolio, as one way of getting some sort of hedge against volatility spike. And at the same time, investors have been looking at gold as potential inflation hedge as well.
So what should people be thinking in regard to their portfolios?
Well, this morning what we saw is that there has been almost a very correlated, indiscriminate markdown in global risk assets. And when we think about how different regions could fare differently from this particular event, this indiscriminate markdown in global risk could throw out interesting investment opportunities. So if you look at the US, if you look at Asia, they are actually less impacted from the prospect of Brexit than the other parts of the world. And if their assets have been selling off, but at the same time supported by a mix of reasonable economic growth as well as a central bank reasonable accommodation, then they could start to look interesting. And even in Europe, we have European credit remain supported by ECB buying, and even in the UK in particular specifically, we could see large cap outperforming mid and small because a weaker sterling could support export-oriented big names. So more broadly speaking, I would just say that it is not time to panic, but rather time to calm down and reassess where revenues are coming from for exposures, for single names, for country indices, and try to identify those quality exposures that actually have been dampened, dragged down, and that could provide interesting opportunity.
On that note, we do have to leave it there, but thank you very much, Wei Li, there from iShares BlackRock, on some of the opportunities that could be out there following the global sell-off following the UK's vote to leave the EU.